I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Ross, a new study commissioned by a lobby group set up now suggested Greater Vancouver homeowners have lost almost $90 billion in home equity since 2018, and that includes first-time home buyers. Do you agree with that assessment?
Well, what I would say is that, they've actually understated what the true loss is and will end up being recorded as being. I think this was the study it was done to support, there's a bit of an irony here. It was done to support removing the vacant home tax and the speculation taxes and the taxes on properties over $3 million in Vancouver. So the people who were funding this report, their objective was to get those taxes removed. And the primary reason that they want the taxes removed is because they want the housing prices to go back up to what they were in 2016 and continue to go up higher, because that makes their home equity increase, and it has a real wealth effect on those who are already existing homeowners. What doesn't come into the conversation is, though, that these things are not sustainable anyways. The ludicrous assumption that has perpetuated the conversation about housing, that housing prices can only go up, defies logic. And I'll explain it to the listeners this way. If you go into a bank, the bank is really not qualifying you for a $400,000 mortgage. So they're not really looking at your income to decide if they can afford to lend you $400,000. What the bank is doing is they're going in and qualifying how much of a monthly payment you can make. They couldn't care less how much money they lend you. All they want to do is know whether or not they can lend it to you and you can repay it at a certain given percent of your income. And this is where so much of the housing discussion has been skewed over the last 8 years. When you look at housing, if you made $100,000 a year in 1990, so if you're a real estate salesman and you made $100,000 in 1990, the government would allow you to spend $32,000 a year on your home. They would qualify you based on you spending $3,200 a year, $32,000 a year on your home, 32% of your income. If you were a real estate agent making $100,000 in 2019, the government and the banks still say you can spend $32,000 a year of your income on your housing costs. Now, what's the difference between those two scenarios is simply the amount of interest that you pay and the amount of principal, home equity. And when you're paying down home equity at a historically rapid rate, as we are right now, you're allowed to take on a higher amount of mortgage debt because your payment doesn't change. The amount of your income, if you're making $100,000 a year, $32,000 a year, doesn't change. It hasn't changed from 1990 till 2019. We did go through little periods there where it went up and down, as we've discussed in other shows about the mortgage qualification rate, B20 rules, change of amortization, credit scores allowing you to go up to 39% of your income qualifying for your monthly housing costs. But basically, Canadians in general have always been between 30 and 32% of their income they can spend on their monthly housing costs. It doesn't matter whether it is a $400,000 mortgage or a $100,000 mortgage. And how does this apply to this step-up discussion? What they're doing with this discussion is they're saying the sandbox that people purchased their homes in and have been living in over the last 30, 35 years has never been changed. It's the same sandbox. And then in 2016, you started to change the sandbox. You started to change the rules. You brought in the foreign buyer tax. You brought in the mortgage qualification rate. You threw in a $37,000 boost to first-time buyers. You took $37,000 boost back out. You threw in property tax changes. All of these changes took place over the last 2.5 years. And those changes took place, changing the entire sandbox that we played in for the last 30 years. And it's different now. And we want it to go back to the way it is. Now, what I'll say is this, Jim. I don't think it was fair to first-time home buyers or people moving the first step up the property ladder for the government to allow them to do that without advance notice that the rules were going to be changed. I think, in all fairness, that borders on, it's almost fraudulent from our perspective. If you're going to bring in a rule that is going to impact the value of something that the public is buying, which the government itself is insuring, which the government itself is relying upon to drive the economy, you shouldn't allow someone to enter into a contract, 5 years for the sake of a 5-year mortgage term, and then change the rules, change the sandbox the first year or 2 years that those people have been playing in the sandbox. In other words, they made a rational decision, just for the sake of the argument, to spend 32% of their income, $32,000 a year. If you spend $100,000 a year, make $100,000 a year, and you expected the sandbox would be played in the same way that it always was, because no one told you it was going to change. And this is the unfairness of these rules and regulations. They needed to really bring these rules in 5 years with a 5-year advance warning, because that would have given everybody 5 years to make changes to the decision-making process, to do different calculations on the numbers. By not giving that lead advance warning, by having a young family go out and enter into a purchase agreement on a brand new home, which they were then going to incur 25 years of debt paying off, and then the next month changing the sandbox, which maybe is going to cause that young family now to have to pay 35 years of mortgage debt because the sandbox has changed. It's wrong. I believe that is wrong. You should have given advance notice. Look, and I'm someone who says the sandbox should have been changed back in 2008. It shouldn't have waited that long to change. You should have changed the sandbox in the correcting housing market back then. You don't change a sandbox at the peak of the market, as all of the governments across Canada have done. You do it in the trough, not at the peak, because there's always less damage done to regular Canadians when you make changes in the trough. When we're looking at British Columbia right now, you talk about $90 billion in Vancouver. When we look at British Columbia, we're tracking about 1.4 million homes in BC each month. So the home ownership stock that we track, or the tradable housing stock is what we call it, there's about 1.4 million homes in British Columbia that we're looking at. Those homes already have recorded a $265 billion loss. $265 billion loss in home equity. You just haven't seen it yet because those people are not looking to exit the market. If they all started to exit the market, which they will begin doing at a certain time in this cycle, then the $265 billion is going to look pale. It's going to look minor. It's going to get worse. This loss is going to get worse. And the way that this was done, it was really, really irresponsible to have a group whose sole purpose is to get as much immediate gains in their home's value as possible, leading a discussion on rational policy changes the government should be making. In other words, this group didn't come out and say, hey, we should have had 5 years notice so that if we wanted to exit the market, we could exit it, and the new person acquiring our home knew that the rules were going to change 3 years down the road, because that would have mitigated some of the damage. The first-time buyers. Someone should have told those first-time buyers that the $37,000 boost to first-time buyers was going to be removed from the Sandbox again. But they didn't. They waited, they dangled it in front of them, so those people went out and bought a condo, or in the greater Vancouver, it would have been a condo. They bought a condo in greater Vancouver. And then within months of them closing on the sale, the government says, we're going to take the $37,000 back out and change the Sandbox again. And now, here we are, 2019, and now you're hearing, reluctantly, people starting to admit the condominium prices are dropping. Now, had they listened to us on Howe Street back in 2016, so almost 3 years ago, they would have heard us explain that the condominium prices were going to drop as well. I can't tell you, Jim, how many producers of media outlets called me trying to give me a rebuttal about my comment that condo prices in Vancouver they've already recorded a falling. You just haven't seen it yet. It's going to take you another year and a half before it starts to be recorded. And you get to a point where you're arguing something over and over and over again, and even though a year later, 2 years later, everything you said has come true, they still want to argue with you. And you reach a point of, why am I going to bother? And this is a case right here we're looking at here. If I'm to say right now, the British Columbians have lost $265 billion, $250 billion in home equity since 2016, I'm going to have a whole bunch of people arguing that that's not the case. Well, when StatsCan does their calculations in 2020 for the 2020 census, I'll be proven correct again. Because this is how housing markets work. The government should have given everybody 5 years notice, or they should have waited till the correction, which was already ongoing as of the fall of 2015, had reached the trough, and then they could have instituted their new rules. And I only say that. I'm not saying that for any other reason than there was probably in British Columbia somewhere around 30,000 purchases made by first-time buyers and people taking their first step on the property ladder, up the property ladder, where those people are now going to be encumbered by extra debt for a longer period of time over their lifetime because they weren't given that advance notice. Look, the older people who are in houses that are worth $1 million, $1.5 million, $2 million, they benefited from the sandbox that they were playing in already. They had an opportunity to exit that market because we gave public notice on several media outlets in British Columbia and here on Howe Street exactly what was going to happen. So I have no real sympathy for those who didn't take advantage of our warnings. No more than those who went out and bought in 2016 when we were telling our members, don't buy. Our members now, some of them, are millions of dollars wealthier because they were purchasing properties in the $6 to $7 million mark, and those properties now have come down to $3 to $4 million. So they are literally millions of dollars wealthier because they listened to us in 2016. You are already $265 billion of lost home equity in the province of British Columbia. That is going to have a fallout across your province that is unrecoverable from. There is no way to recover from this. Your housing correction is really, you're probably halfway in your housing correction, but it still looks like you're only in the first 10% of it, because you're still reading outdated data. When we're looking at our data, we already see how deep this correction is into your marketplace. And over the next year, 2 years, you're going to get up to that 50% of the correction that you're into, and then you still got to go another couple of years before you're out of it at the earliest. And getting out of it is even more of a difficulty than getting into it was. And when you end, I promise all the listeners, British Columbia homeowners will have lost far more than $250 billion when this is all finished and recorded in the wash.
We'll have more with Ross Kay right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Welcome back. We're speaking with Ross Kay. Ross, a listener asks, Toronto's experiencing a slight softening of prices, but nothing on the scale of Vancouver. Toronto's housing cycle seems to lag Vancouver's by about a year. Do you see a big correction for the GTA, and when?
Okay, so I would tell this listener is that, look, all housing markets, as we have said on this show, if they're regular listeners, they would have heard us say this over and again. They all function exactly the same. So it's not that Toronto's is a year later. I mean, that was something that some newbie housing would-be analysts tried to come up when they were explaining Toronto in 2017, not responding the same way that Vancouver was. Because the cycle is impacted by a whole bunch of variables. In other words, the cycle in Mississauga is going to be different than the cycle in Toronto. The cycle in Toronto is going to be different than the cycle in Hamilton or Windsor. The cycle in Windsor or Hamilton is going to be different than the cycle in Vancouver. There are a whole bunch of series of reasons why these cycles don't follow the same timeline, although the pattern is identical. So I'll explain it to your listeners. This is one of the easiest ways to explain it. Let's say that Toronto, because it has a more stratified housing stock, in other words, a property ladder, you can work your way up the property ladder very easily in the Greater Toronto area. It's more difficult in the Greater Vancouver area. Because you can move up the property ladder quicker, that means people turn over their houses more quickly. In other words, maybe the Greater Toronto area over the last 10 years, people are moving after they have only been in their house 8 years. Where in Quebec, they may have been in their house 14 years before they moved. Okay? That drastically changes those two housing markets. Now, the changes are going to be mathematically calculated the same way. And I'll give you a little nugget for your listeners here. When people are trading houses more rapidly, so in other words, you've been in your house 8 years, you go buy another one. you are at a certain point in your amortization schedule you're in your 8th year of that amortization schedule. Okay? If you are in Quebec, and let's say for the sake of the argument, we're talking 14 years. I'm not saying this is exactly true. I'm just saying let's use that example. You are in the 14th year of your amortization date. What that means is, if you're making the exact same mortgage payment in Toronto than you are in Montreal, Quebec, the Quebec homeowner is paying down their mortgage debt more rapidly because they're in their 14th year versus the owner in Toronto who's in their 8th. That means those people, in turn, in Quebec, don't need as high of house price gain to allow them to move because they're paying down their mortgage. So their home equity is being built more quickly through paying down their mortgage debt, simply because they've lived in the same house longer than the family in Toronto, who, since they're only in their 8th year of their amortization schedule, requires a higher house price gain for them to be able to move. So here's two totally different housing markets, two totally different sets of housing stock, two totally different property ladders that are being navigated in different ways by two separate ways of the buyers being active in a housing market. Now, the calculations for these markets, well, is exactly the same. It's only the timing, like what factor you're using, which is going to alter the case. And this goes back to the original question of Vancouver versus Toronto. Vancouver and Toronto are correcting exactly the same. It is no different. The lag that was perceived has nothing to do with the Toronto housing cycle being behind Vancouver. It's the structure of that Greater Toronto housing market is totally different than the structure, home ownership market is totally different than the structure of the Greater Vancouver home ownership market. It's two totally different structures. And when you apply the exact same math on those two areas, the Vancouver market responds quicker than the Toronto market does. It's got nothing to do with a lag. It's got nothing to do with foreign buyers. It's got nothing to do with money laundering. It's got to do with the two markets are structured totally differently. This is no different than the banks reporting their profits last week, Jim. Like it's no different. When CIBC, we'll use this example, they were aggressive building their mortgage book over the last 5 years. More aggressive than RBC was. Last year, CIBC decided that they're going to quit booking as many mortgages because they had already booked so much over the previous five years, new mortgage debt. Where Royal Bank has continued to book mortgage debt in a correcting housing market. Royal Bank beat expectations on their profits. CIBC got worse. Now, how is that possible? How can RBC be taking on more mortgage debt in a correcting housing market and be making more profits while still meeting the risk assessment that the government requires all banks to follow? It's the exact same risk assessment. They've got to have the same reserves for foreclosures or whatever. All banks have to follow the same rules. Well, the reason why the Royal Bank's profits can rise because their mortgage book, so the median point of the amortization of their overall mortgage book is lower than the bank of CIBC. So CIBC's owners are not paying down their mortgage debt as rapidly as RBC owners are. So in this understanding, RBC, they could take on $100 billion more of mortgage debt over the next 2 years, and CIBC could take on $100 billion of mortgage debt over the next 2 years. But because RBC's older mortgage book was further down the amortization chart, when you average them all out, their risk profile is still less than CIBC's. And that's exactly how you measure a housing market. If you're not measuring the trading rate, if you're not measuring the tradable housing stock, if you're not measuring the mortgage origination debt, if you're not measuring how your property ladder is stratified in a housing market, if you're not looking at property taxes, if you're not looking at provincial income taxes, if you are not looking at GST, HST taxes, if you are not looking at transportation infrastructure, if you're not taking all of those things into your calculation, then you're just guessing. You're coming up with an answer that, Toronto's a year behind Vancouver. No. It's a totally different structured homeownership structure in the Greater Toronto Area than it is in Vancouver. The numbers all work exactly the same. The cycles are all exactly the same. Just one goes quicker than the other. It's no different than being on a bicycle. If you can put it in first gear and pedal your pedals, your feet are going really quick, but you're not moving along very quick. If you put it in third gear, your feet are moving slower, but your bike's going quicker. That's exactly how a housing market works. It's just a bicycle with a different gear. If the Vancouver housing market, it was in fourth, and it took less number of turns of the pedals to make the market go quicker, and Toronto's was in second, they had to make more turns to make the market go similarly as quick, then the markets look totally different when really they're identical. It's just the impacts on a housing market it's such a wide variable, Jim. It's a wide group of metrics that you have to be measuring. But this is where they're so predictable. This is where we can say, look, if we ever made a mistake, you have all your money back. We don't care, because we can't make a mistake, because we're reading all of these variables, and we know how they're impacting each housing market at that given moment in time. It's when the banks are announcing their quarterly profit margins, and we hear all these, supposed experts commenting about, CIBC missed its targets. RBC missed its targets. We're sitting there, what are you talking about? This is exactly what they have to report. This isn't, you clearly are looking at them as single entities, all functioning in the exact same way, when in fact they're not. They have the same set of rules, but depending how they're set up, they're functioning in a different manner. Same with your housing stock. So the Toronto housing cycle is identical to Vancouver's. Do we foresee a significant correction for the GTA? You have already had your 30 and 40% drops in prime areas for Toronto real estate, the same as your 30 and 40% drop in prime areas of the Greater Vancouver market. One happened quicker than other because the market was functioning at a different gear than the other one. Your correction is ongoing. If you're making a decision and you don't know where the market is going to end up, I suggest you get out there and get a hold of somebody who can explain to you all the things we just talked about briefly here in this on this show.
We'll have more with Ross Kay right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, 10-year bond yields have dropped back again. A listener was asking whether this is the time to go long with a mortgage or maybe just stay short-term.
You know, probably one of the most common asked questions in the history of personal finance, next to should I buy or should I rent, is should I go long or should I go short in the mortgage? And most of the conversations that take place over this are not the answers that come out of them is not generated in a way that's going to create harmony in your life. And harmony in your life is something that is really, really, really valuable. Your mortgage, there is always going to be some fluctuation in the amount of mortgage interest that you pay, depending on the choice that you make. So this is something I want your listeners to simply accept. You are not going to be perfect choosing the mortgage that is going to be the best in terms of delivering the lowest interest cost over the next 25 years. It's not going to happen. It's not like a housing market where we can say, look, the market's going to turn in 6 months, or the market's going to be this place in a year. Mortgage is a little bit different because there are factors impacting mortgage interest rates that you have no control over. Mortgages can turn on a dime where a housing market can't. Two totally different things. The consumer needs to step back and ask themselves, as a mortgage person, what is going to make me happy? I'll tell you right now, the most underlooked at mortgage in the history of Canadian home ownership is the 10-year mortgage. It is the most underlooked tool of creating harmony in your life that has ever existed. And I know that there's going to be people who are going to say, well, Ross, you pay more. Yes, you would have paid more interest if you had taken out a 10-year mortgage between 1988 and right on through till 2016. You would have probably paid more mortgage debt by opting for that choice. But what I would tell you is, you had 10 years of worry-free life. My home payment is not going to change in 10 years. This is what the advantage the Americans have. They have a set mortgage payment for 30 years. If I buy this home today, other than making changes to it, repairing, renovating, and maintaining it, my mortgage payment is going to be the same for the next 30 years. I can book my life. Now, because of that, the American home trading infrastructure is built differently than the Canadian system is. The Canadian system is actually based on a 5-year set fixed term mortgage. Now, I say that because realtors in Canada have dominated the conversation far more than realtors in the United States. And what do realtors want? Realtors want you to move as quick as the highest number of times as possible while they know you. If they could get you to move houses every 3 years, that's what they get you to do, because they get a commission every 3 years. A 10-year mortgage automatically lowers the trading rate. In other words, it lowers the number of times that you're going to move in your lifetime. It's just a natural consequence of that. That's why your house price changes in the States will never be the same as they are in Canada. Okay? The Canadian system is built on a 5-year mortgage renewal, which allows a 10-year trade to take place. It also changes based on the amortization. So when we had 40-year amortizations, there were young couples who, 5 years, 10 years into their mortgage payment were still like, it would be similar to, let's say, 17 years. You're 17 years into a 25-year end. Or excuse me, you're only 7 years into a 25-year end, because that's where you are on the amortization schedule. So these mortgages that you're talking about, you should be talking about it from how you are going to live over the term of the mortgage. Yes, 10-year bonds are extremely low again. Now, they're not back to that low of 2016, but I mean, they're down, they're getting there. You can get a 10-year mortgage now for around, for under 3%. Okay, so you're going to pay a little bit more interest on it to get that 10-year security. But you've also got to remember you're probably going to get a raise every year, and inflation's going to hit that mortgage payment. And with each passing year, that mortgage payment will be a smaller share of your income. And it will be technically dropping because inflation is doing that to the payment. You make the same payment, it's just that in dollars the following year, technically you're not paying as much because it's not the same dollars. That's really where this discussion about mortgages is wrong. I read an article in the Weekend Gym where they were discussing should a first-time buyer wait for another 5 years to come up with a 20% down versus a 10% down, and it was some financial advisor who's making these comments, and then a mortgage broker or somebody else. It was just ludicrous. I know that's my favorite word. Ludicrous what the advice they were giving. They weren't looking at it with how people interact with their homes. And the result is they gave an answer that I would never give. I would be embarrassed to have given the answer. And this is where we are with the bond yield. Yes, bond yield.
So, Ross, I'm curious, what's the answer to that question?
Well, the answer to the question is, what housing market are you buying in? What category of home are you buying? What job do you have? What income profile do you have? What are the current mortgage rates? Where is that housing market in its trading cycle? And then when you answer all those questions, you can tell people whether or not they should wait. And it's not even a debatable topic. You can guarantee it if you want. We can guarantee to someone that this is the pattern that they should follow. And 5 years from now, if you don't win, well, your money back. I don't care. Because you can't be wrong when you're looking at all of these variables. When you only look at one, Jim, you got a major problem. You have a major problem when you're leaving, if you just leave one of the key decision makers out of the process. This is your housing stock, your housing prices. If you look at the benchmark price in Vancouver, for the sake of the argument, I think it's down about 8 or 9%. That's all it's showing. Yet there's houses that are selling 50% off what they were selling at peak. That's because you're looking at one metric. And it's a metric that is built out of a whole bunch of other metrics, bathrooms, kitchens, lot size. Oh, but it's the same home. No, it's not. That's hogwash. It changes every single month because that's the houses that you're measuring the bathrooms on. And you can't come up with an honest answer when you're only looking at one metric, which is the same way with what's the best mortgage term you should take out. Well, look at the 10-year bond yield, the 5-year bond yield. No. There's a whole bunch of variables you have to look at, and then the person makes an informed decision what route they should go. They shouldn't be making the same decision as their neighbor next door does, or their cousin in Vancouver does, or their neighbor who moved up to Kirkland Lake does. It's all different for each person. And maybe that's why it's so complicated, Jim. Maybe that's where the real problem is. Because you have to be looking at all these things. You can't run an ad telling people what to do. You can't do an article giving advice. You can't appear on television making a recommendation, because the recommendation you're making is to one person. All the other people that are listening in, who are believing this is the advice they should be following, need to be following different advice. So the mortgage advice that we give to everybody is the same that my dad taught me to give to people when I started selling real estate. Okay? There is a certain amount of mortgage debt you should take on. There is a way to calculate what is the maximum mortgage debt you should be taking on right now. You should be looking at, where are you on the amortization table? If you're trading up homes, okay, the new mortgage debt you're going to take on. Where does that fit in the on your overall mortgage debt, changing your amortization table? Are you going to extend the amortization schedule on your existing mortgage debt? Or are you going to leave it where it is and you're going to add more mortgage debt to it? I'll tell you what most people do, Jim, is they extend it. I mean, the biggest myth in home ownership is that people pay off their mortgage in 25 years. That's the biggest myth out there. And it's being proven true now when you hear about all of these boomers who still have mortgages. Well, of course they have mortgages. They only finished the property ladder when they were in their 50s. When they made that last step in the property ladder, they still probably took out a mortgage that had a 20-year am. They are still going, they may not have thought it would last that long. In other words, we'll take it 20 years, honey, but we'll pay it down in 10. We'll get rid of it in 10. Okay, well, now it's 15 years. It's still not paid off. Or you realize you shouldn't pay it off. It's a rational, financially beneficial move not to pay it off. That mortgage is 20 years at the end. So now you're 70 with a mortgage, and all of a sudden mortgage data across Canada claims that Canadians are more indebted. No, it's not, people. They just made the last step up the property ladder in their 50s. They followed the same pattern everybody has been following in terms of taking out a mortgage. They're paying it off the same way that everybody has paid it off for 30 years. They are now in a property that is worth more money than they ever could have imagined, even though it's dropping in value right now. But it's got nothing to do with people taking on more mortgage debt when they're in their 70s. It's just that the mortgage debt is still outstanding because they made the last step in the property ladder in their 50s. They took one extra step that the vast majority of Canadians never took in the previous generations. People didn't buy ultra-luxury class homes in their 50s. They stopped at the luxury class. But as our housing stock builds, our home equity pyramid gets taller, our property ladder gets taller, there's still more steps to take. And some people will take it. And that's what's being measured when you hear about people being measured with boomers carrying mortgage debt. No, they're just finishing off that last step of the property ladder. 10-year bond yield. Should you go long or should you wait? You need to look at all of those factors, sit down, make a rational decision that's in harmony with how you want to live your life. I will tell your listeners this, and this is from dealing with thousands of homeowners. Variable rate, short-term, 6-month, 1-year mortgages, I believe, have caused more family problems than anything else in history. The variable mortgage causes stress with families the second they move into that house. They spend their life watching the mortgage interest rates and fearing that mortgages are going to go up, and should I be locking in? Because that's what the next question that follows. Should I lock in? Should I lock in? Should I lock in now? Should I lock in 6 months? Should I lock in a year from now? There's only a very, in my opinion, from my perspective, a very, very small select group of the population that should ever take out a variable rate mortgage, ever. That should ever take on a mortgage of a year or less, even 2 years or less. A very, very small group of the population should do that. And my perspective is one from the results of the conflict that happens watching mortgage rates every month of your life versus living life, enjoying your home, putting a garden in the backyard, trimming your trees, fixing your doors, going on a holiday. It's your choice. You know, live the life that you live, and at all costs, try to be as wealthy as you can.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or anybody else on our show, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.